Hey everyone, welcome back to Corporate Decoder, the place where we peel back the layers of corporate jargon to find the juicy bits. Today we're diving into Super League Enterprise Inc. Its latest filing with the SEC document that might sound dry but is anything but when you look closely at what it's revealing about their plans and their financial health. Before we get into the nitty-gritty, if you are someone who likes to understand exactly what is going on behind the scenes of big companies, and not just the press releases, then make sure you are subscribed to this channel. Also, we have a growing community on Discord where we break down these reports even further, so I'll link that down in the description later. Alright, so what is this filing all about? Super League Enterprise Inc. is essentially telling the market they are registering a whole bunch of shares of their common stock that can be resolved. Think of it as giving existing shareholders the green light to sell their shares to the public. This particular filing is a Form S-3, a type of registration statement companies use when they want to offer their securities on a delayed basis. This means they can sell these shares over time as needed. The company Super League Enterprise Incorporated is in the business of redefining how brands connect with consumers through playable media. They use mobile games and immersive gaming platforms to create ads, content, and experiences that people can actually interact with. It sounds pretty modern, right? They generate revenue from advertising direct to consumer offers in content and technology. Now, this filing is about registering a massive amount of shares, nearly 50 million shares. These shares are either already owned by some investors or can be obtained by them through exercising warrants. We are talking about shares from the initial offering, pre-funded warrants, pipe warrants, consideration warrants, and placement agent warrants. Essentially, a lot of potential shares hitting the market. It is important to note the company itself isn't getting any money from the resale of these shares by the selling stockholders. However, they might get some money if these warrants are exercised for cash, and that could be a significant amount. They plan to use any such proceeds for general corporate purposes, working capital, and strategic initiatives. As with any filing, especially one involving a large number of shares being registered for resale, there are significant risks involved. The company itself highlights this prominently. Investing in their securities is described as highly speculative and involving a high degree of risk. They want you to be prepared for the possibility of losing your entire investment. This document was filed in late 2025, which gives us a snapshot of the company's situation around that time. The company's common stock is listed on the Nasdaq Capital Market under the symbol SLE. A significant event happened in 2025, a reverse stock split at a hefty one, for -40 ratio. This is usually done to increase the stock price per S-share, making it more attractive to certain investors and meeting exchange listing requirements. All share and per share amounts in the prospectus have been adjusted to reflect this. So let's really dig into the risks, because that is where the meat often is in these filings. The company is very clear you could lose all of your investment. There is a substantial risk of dilution to existing stockholders because of these nearly 50 million shares being registered for resale. Also, the sale of these shares could potentially drive down the stock price. A crucial point is that there is no public trading market for a lot of these instruments, the pre-funded warrants, pipe warrants, consideration warrants, and placement agent warrants. This means they are not easily bought or sold on an exchange, and holders don't have stockholder rights until they exercise them and actually get the common stock. The company acknowledges that their stock price can be very volatile. This volatility is influenced by many factors, including industry changes, competitive pressures, their ability to get financing, and even general economic conditions. They list a whole bunch of factors that could affect their stock price, and frankly sound like they are preparing investors for the worst. Here is another key point for potential investors. Super League Enterprise Incorporated has never paid cash dividends and doesn't expect to in the foreseeable future. This means any return on investment will likely come only from the appreciation of the stock price. So if the stock price doesn't go up, you likely won't make money. The company also includes a standard cautionary note about forward-looking statements. These are statements about the future that are based on current expectations and assumptions. They warn that actual results could be very different due to many known and unknown risks and uncertainties. They are essentially saying, be careful, we're stating our best guess about the future, but a lot can happen. Digging into the details of how these shares and warrants came about, we see that between the 22nd of October and the 27th of October 2025, the company entered into agreements to sell these securities to certain accredited investors. They sold shares of common stock and pre-funded warrants for each share or pre. Funded warrant purchased investors also received additional warrants, namely pipe warrants. On top of that, there were consideration warrants and placement agent warrants issued. This was a private placement, meaning it wasn't offered to the general public initially. The company received about $20 million in gross proceeds from this offering. A really important aspect here is the registration rights agreement. This is pretty standard in private placements where investors want the company to eventually register their shares so they can freely sell them in the public market. Super League agreed to file a registration statement on Form S-3 to allow for this resale. The table of selling stockholders is quite extensive. It lists entities and individuals who may be offering their shares for resale. What is interesting here is to see the breakdown of who owns what and who is looking to potentially sell. For example, Aegis Capital Corp is listed as a selling stockholder, and they also acted as a placement agent. You can see names like Alta Partners, LLC, Alta Opportunity Master Fund, and several others. Looking at the table, the number of shares of common stock beneficially owned prior to offering column shows a snapshot before this registration. Then the maximum number of shares of common stock to be offered pursuant to this prospectus gives us the potential sell-off volume. You can see millions of shares being offered by some of these entities. For instance, Evo Fund 20 million shares, Automatic Worlds LLC over 4 million shares, and Yield Point NY LLC over 3 million shares in this offering. This is a lot of potential selling pressure on the stock. The plan of distribution section explains how these shares can be sold. They can be sold on the NASDAQ Capital Market or other stock exchanges in private transactions, or through brokerage transactions. The selling stockholders have a lot of flexibility in how and when they sell these shares. They can sell them at market prices or negotiate different prices. As mentioned earlier, the company itself won't receive proceeds from the resale of these shares. However, they might receive proceeds from the exercise of warrants. They estimate receiving up to about $29.7 million if all the warrants are exercised for cash. This is a significant potential inflow of cash for the company. Now let's talk about dilution. This is where things get a bit technical, but it is super important for investors. The filing calculates the net tangible book value per S-share. As of the 30th of September 2025, it was a negative $4.02 per S-share. This means that if you liquidated the company assets, you would not have enough cash to pay back all the liabilities, and there would be nothing left for shareholders. After accounting for the issuance of all these new shares and the potential exercise of warrants, the pro forma net tangible book value per S-share is projected to be $0.80. The offering price per S-share is listed as 1.00. This results in a dilution per share to new investors in this offering of $0.20. This means that for every share bought at the offering price, the book value per S-share decreases. In simpler terms, existing shareholders are diluted and new investors are buying into a company where the book value is less than the price they are paying. Back to the risks, because this is where you see the real picture often. The company is exposed to competition pricing pressures and the ever-present challenge of generating consistent revenue. Their ability to execute their business plan is critical. Any failures in this area could lead to significant losses. They also mention potential litigation, which can be very costly and distract management. A major risk they highlight is maintaining their NASDAQ listing. If they fall below certain standards like a minimum bid price for their stock, they could be delisted. This would severely impact the liquidity of their stock, making it much harder for investors to buy or sell and potentially turning their stock into a penny stock. This filing also incorporates by reference previous company reports like annual reports on Form 10-K and quarterly reports on Form 10-Q. These documents provide a wealth of historical financial data and business insights that are crucial for a complete understanding. They have filed quite a few 8-K reports which signal important current events for the company. So what is the overall picture here? Super League Enterprise Inc. is trying to navigate a very fast-paced industry. They are registering a massive number of shares for resale, indicating a significant potential influx of stock into the market, which inherently carries dilutionary risks. The company has a negative net tangible book value, which is a red flag suggesting that its liabilities outweigh its tangible assets. While they have a plan involving playable media and brand connections, and they've secured funding through a private placement, the risks are substantial. The company's future hinges on its ability to execute its strategy, generate consistent revenue, and crucially avoid being delisted from NASDAQ. The sheer volume of shares being registered, coupled with the lack of public markets for many of their warrants and the already volatile nature of their stock, suggests a very high-risk investment. The dilutive nature of the offering and the negative book value are serious concerns that any investor must weigh very carefully. Alright, that is our deep dive into Super League Enterprise Incorporated's latest SEC filing. What are your thoughts on their strategy and the risks they're facing? Let me know in the comments what you think about this filing, and if you found this breakdown valuable, smash that like button and subscribe for more corporate investigations. And don't forget to join our Discord community linked in the description to continue the conversation. Thanks for watching, and we'll see you in the next episode.